So what is the best investment strategy then as you think about these periods of volatility that we
Yeah,
could see, but ultimately what sounds like a pretty
yeah,
good fundamental picture still?
yeah, yeah. It's a great call out. And look, I think what's worked this year has been that diversification story, that diversified portfolio across equities and bonds, across US and international, and across large cap and we'd say mid cap. So we still favor large cap, mid cap US equities. From a sector perspective, while we continue to like tech, and growth sectors, we like areas like financials and healthcare as well. So a little bit of cyclical exposure, a little bit of defensive exposure in that portfolio as well. And within the investment grade bond space, we still see value in that 7 to 10 year type of
Mhm.
maturity. We think, even at 4.5%, a US Treasury 10-year bill or 10-year note is still pretty attractive for most investors.
So with volatility expected to be ahead,
Yeah.
at least in your view, and it seems like if history is any guide, we
Yeah.
probably will see more volatility. What's your advice to investors to stay grounded as
Yeah.
so many changes and so much shakiness could be underway?
Yeah, I'd say broadly, think about the long-term investment profile. On average, the S&P returns 7% annually, higher than almost any other asset class out there. But we'd say also, think about the US as a source of innovation and productivity. And we've seen that consistently throughout history, whether it's the Mag 7 more recently, the big tech players back in 99, 2000. But really, this is a hotbed, this very supportive environment for entrepreneurs, very supportive for innovation, and very supportive of better productivity and growth generally. And we don't think that story is shifting. So we want to keep investing in areas that are growing, productive, and innovative. And so we think the US market still is a great place to do that.